Hey everybody, I hope everyone's doing well and had a good day. This is the overview of the Emini 5-minute chart for Wednesday, September 25th, 2024. So here we have the daily chart. The market's been in a trading range, and the range is wide. It's about 600 points down and back up, big down. A good looking rally, but a deep pullback, 50%. Another good looking rally, but starting to get a lot of overlap. And even in here, as strong as this rally looks, just look to the left. It's big down, big up. So probably resistance here, probably resistance at the prior all-time high. You can see the market broke above it, pulled back. We're trying to break above it again, and we're continuing to go sideways. You could also view this as sort of a nested spike in channel, where you could say this entire rally is a bull spike. Here's a deep pullback, and the market is channeling up. Or you could say this is a spike, pullback, channel. Or you could even say right here, this one bull trend bar is a spike, and we have a pullback, and we're channeling up here. But no matter how you look at it, the market is high in the range. Leg 1, deep pullback. Leg 2, and leg 2 subdivided into 1 pullback, 2 legs. So I suspect the upside here is limited, and you can see the market is getting a lot of overlap over the past couple of days. Here's the day only session daily chart. You can see doji after doji for the past 5 days. So I think the market is high in the overall trading range, and it's even high in this tight trading range. I think the upside is limited. I think it's more likely we break out to the downside and at least test the moving average. For the 5-minute chart today, I have yesterday's high drawn in blue, and then I have the big round number 5800 in green. And here's bar 1. Bull trend bar, but big tail above. We broke out above yesterday's high, but there were sellers into the close of the bar. And whenever you have selling into the close of the breakout bar, you have to be suspicious. If this is a strong bull breakout, then why are traders selling into the close of the bar rather than buying into the close of the bar? So a prominent tail on bar 1, that's a warning that the upside might be limited. Maybe it's 2 legs up, 1, pullback, 2. Plus, 80% of days have trading range opens. So the odds of this becoming a bull trend from the open, probably about 20%. And considering the context, the higher time frame, the daily chart context, might even be less than 20%. And you can see what happened on bars 2 and 3. Deep pullback, we fell all the way below bar 1, so now we have big up, big down, big confusion. The market is sideways. There's lots of overlap. Now I will say one more thing, because I had thoughts. At this point in the day, actually let me go on a little further. So we have a couple of legs down, bear breakout, pullback, a second leg down, bull, reversal bar, stop order buy, micro double bottom, but forcing you to buy in the middle of a tight trading range, not ideal. But bar 1 should get a second leg, and this may be the start of a second leg up, and then we're channeling up. And then bar 8 broke out to a new high, but pulled back. And I thought this was interesting. On the chart that I was trading today, the platform actually said that bar 8 rallied to 5800 exactly. And then it turned down. And if anyone was watching today, you would have seen bar 8 race up and then very quickly bounce right off this price level. And I double checked on the CME website to make sure this data is correct, and this is correct. So the high of this bar was 57.98 3/4. So for whatever reason, my platform showed that this went to 5,800. But in either case, 3 pushes up to bar 8, close to the 5,800 big round number, and a second attempt to break out above yesterday's high, which, remember, is a trading range bar in a trading range environment. So probably sellers above yesterday's high. Tried to break out on bar 1, pulled back, trying to break out a second time, but not even getting bars closing above these bars over here. High 1 by bar 9, but probably sellers above. Bad context, and this is what I wanted to talk about. At this point, even though we had this rally and we're getting higher lows, higher highs, you could argue the market's always in long, but I thought at this point, by bar 8, I thought the context made the market always in short. And part of that was because of what we've had over the past few days. The market has been in a broad bull channel. You can see market's channeling up, but the swings up and down are big enough so that stop order traders make money when it goes up, and stop order traders can make money when it goes down. When you have a broad channel, you trade it like a trading range that is sloped, so you look to buy low and sell high. And so here we are at bar 8, and this is why I thought the market was always in short. Also, one more thing. The 19th, which was last Thursday, the high of this bar, or the high of this day, you can see bar 1 immediately raced up to that price and failed, and we tried to break out above it again. I know this is kind of messy, but this horizontal red line is the high of last Thursday, the 19th. The market tried to break out above it 2 times and was rejecting it. So if you think about it, and it'd probably be easier to demonstrate this on the 15-minute chart, just because there's a lot of bars. What I'm demonstrating is the big picture. We have a broad bull channel. Here's a bear spike, and then I thought this should get a second leg. Maybe this is the second leg, but I think more likely after any pullback, we'll still get at least 1 tick below this low. So bear breakout, and now we're getting a deep pullback, and it's gone on for many bars in a bull channel. But remember, bull channel means bear flag. And so at this point we have a wedge, 1, 2, 3. It's nested, 1, 2, 3, and it's a double top over here. So I thought there were a few reasons to expect some resistance at this price. So even though you could argue the market was always in long on bar 8, I thought the context made it more always in short, more likely to fall 10 points before it rallied 10 points. Bar 11, we had a bear breakout, and bar 11 is significant. I want to show something with bar 11. And bar 3 was actually similar, but bar 11 is a better example. Look at the overlap with bars 10 and bar 11. And you'll notice that if a trader bought below the low of bar 10, they were trapped and the market went maybe 5 points against them, and that is disappointing. And you have trapped traders. Some bears did not sell below 10, some bulls bought below 10. Both are trapped when the market sells off. And this is an example. I learned this from Ali, where the distance of a breakout is more important than the close of the breakout bar. So even though this closed well above its midpoint, what we might have here is a bear breakout pullback, and this actually might be a breakout pullback sell setup. So you will have some traders sell the close of 11, betting on a second leg down. And then 12, you can see traders sold the close, we sold off, but now we're developing a bear breakout. This is a micro channel for the past 6 bars or 5 bars. And this is strong enough to get a second leg down. The first reversal attempt will probably be minor. So even though we have a good looking bull reversal bar on 13, double bottom, the odds are this reversal attempt is minor. We went a little bit above 13, but disappointing entry bar for stop orders, and then an outside bar 15. We're probably going at least one tick below 13, but the rally from 13 up to 14 or 15, that was strong enough for its own second leg. The problem for the bulls is that it's counter trend. I think at this point it is always in short, and while this should get a second leg, the buyers may not come in until below bar 13. 16, a little bit of a climactic bar, 2 legs down, 1, 2, or it's 3 legs, maybe 1, 2, 3. And again, a little climactic, it will attract some profit taking. Plus, there's probably buyers below 13, scaling in lower for a retest of maybe the stop order entry above 13, somewhere in this area. And then we got another outside bar on 17. The problem is that in this context, we have lots of overlap. It looks like a trading range, and outside bars in trading ranges really don't give any predictive value. Outside bars are expanding triangles, and when you have an outside bar, that just means the market is going sideways. Like 15, we broke out above 14, we broke out below 14, we closed within the bar. So we tried to break out up, we tried to break out down, we failed both times. It's the same thing here on 17. Tried to break out below, tried to break out above, closed within the prior bar. So there's a lot of overlap. The problem for the bulls buying above 17 is the trader's equation. Let's say a trader wants to buy above this bar. You buy one tick above the high, and you can see the one-to-one of your risk reward is 5,800. But what's the probability the market rallies up here before it pulls back? It can't be 60%. And if it's not 60%, you cannot take a one-to-one trade. So traders will probably not buy above 17. There might be more sellers above. We rallied for 3 more bars, but I thought this was interesting. Markets are fractal, and the more you study and the more you look at charts, you start to notice these kinds of things. Bar 17 is a bull spike. Every trend bar is a breakout, a spike, a climax, and a gap. So you can view bar 17 as a spike, and then we had an inside bar on 18, that's an implied pullback, and then look at bars 18 through 20. We're going higher, we're getting trending closes, trending opens, trending lows. The market's channeling up on these bars, so what we have here is a spike and channel bull trend on a smaller time frame. It's just that we see it on the 5-minute chart over 4 bars. The problem here is kind of what I was saying on the daily chart, similar idea. Now we have 2 legs up. Maybe you say this is leg 1 up to 15, deep pullback, and this is leg 2. And this is leg 1, pullback, leg 2. And I'll pull up a smaller time frame to explain this better. But the point is we have a double top. And if you think through the market cycle, the market has a breakout phase, the strongest phase in the trend. And then it pulls back and it begins to channel, and it will continue in the direction of the breakout. But the channel evolves into a trading range. So at this point, I think the odds are we will test the low of 18 before we go for a measured move of this range up here. And that's because of the market cycle. Channels evolve into trading ranges. It's less likely we get a bull breakout of this bull channel. So if we look at a 1 minute chart up to 11:10 Eastern time, it's not great, but this is what I'm talking about. We have a spike, pullback, and then a bull channel. Low, higher low, higher low, high, higher high, and then a truncated wedge. 1, 2, 3. Third push did not break out above the second. So I thought the odds were we'd find resistance in this area, and I thought the breakout or the leg down from bar 8 to bar 17 needed a second leg. This was tight enough that it's probably a breakout on a higher time frame chart. This might be a deep pullback, but I think the odds are we will fall below bar 17 before we rally above 18 or bar 8. And then 21. Traders held the close. We get a good breakout bar, but buying into the close and lots of overlap, so not ideal. Bad follow through. So we're getting trend bars with bad follow through. There's a lot of overlap through here. Breaking out again, but now we have 2 legs down. 1, pullback, 2, and you can say it's leg 1, deep pullback, leg 2. I still think we'll get 1 tick below this bar, but there might be buyers there. This may need a second leg up. 26 might be the second leg from 17 to 20. If you think about it, some bull bought the close of bar 20 for whatever reason, or a bear did not sell and they were trapped out of a good trade. The market went a decent distance from this close. So any retest, there's probably resistance, sellers above. So we tried to retest that price, and then we immediately fell. We fell and tested the low of bar 17 on 28. Now at this point, maybe it's 3 pushes, 1, 2, 3. But there really hasn't been a credible buy signal bar. 25 is a weak buy signal bar for stop orders. 28, not really credible. We're getting lower highs, and we may not be getting lower lows. The market might be in a triangle, which is breakout mode. And we know it's breakout mode because of all the overlap. The market's in a trading range. And if you go back to what I said earlier in this video, we're still high in the broad bull channel. So I still thought at this point, this is the top of the bull channel, this is the bottom. I thought the odds were we would fall further and get some sort of bear swing before we got a rally far above today's high. Market trying to break out of this triangle. Now we're getting lower highs and lower lows, so you can call it a bear channel. But lots of overlap. One thing the bears have going for them, there's a gap from between these bodies, so the close of bar 20 and let's see, bar 6, or the close of bar 5. So we have a gap there. This breakout created a gap, which means there were trapped traders. And then there's a gap here on this breakout down to 29. And if we look at the close of 16, 57.87, the close of 30, 57.87, so the exact same price. So the market tested it to the tick, but did not overlap it, and then you can see what happened. So we have a negative gap, or a body gap. So on this chart, there is some overlap with the breakout point, but on a line chart, which plots only the closes, you would see it would touch the same price but not overlap. And that's a subtle sign of strength by the bears. So even though there's a lot of overlap, there are signs that this could be a small pullback bear trend. Although I keep going back to the higher time frame context, I don't think it was all that likely that today, especially with all this overlap, would become a strong bear trend and have relentless selling all day long. If you think about the past few days in this broad bull channel, anytime we have selling, it's followed by a very deep pullback or some sort of rally. Selling and then a strong rally. Sell off and then a strong rally. Another sell off, but then we rallied again. And so the downside might be limited. And that's why, let me see if I can. I'll keep the bull trend line drawn. Something like that. Because the market's been reacting to that price, this level, this line, over the past few days. Every time we touch this line, we rally. Going sideways to down, I think bar 32 is kind of similar to bar 11. So it doesn't look like the strongest breakout bar, but any trader who bought below 31 was disappointed with their entry bar. And this breakout may have to get a second leg down. 35, thinking about the bull case, if we're thinking about a wedge bottom, you can count 3 legs down, lots of overlap, maybe you buy above 35, but the odds are this reversal is minor. The buying pressure through here is not great. It's not terrible, but we do have an open gap here. I would consider this an open negative gap. And if you just count the number of bull closes compared to the bear closes through here, we have more selling pressure, plus lower highs, lower lows. I think realistically the bulls need a trendline break. We're starting to collect more bars below the moving average, and the market again might be in a subtle bear trend. We rally close to the moving average, we sell off. 37, another example of that kind of breakout bar, like bar 11. 36 is realistically not a good stop order sell. So a bull might buy below 36. Maybe they even buy at a distance below 36. Maybe they buy 1 times the range down of 36. But even if you did that, and you entered somewhere below 35, that's your entry bar. And it's not ideal. So if you bought below 36, that's your entry bar. Then, again, remember, if you're a bull and you're buying, you would like for the market to trigger your limit order and rally. But instead, we sold off for about 4 points below your entry price. And after a 5-minute bar, we're right back at your entry price, and that's disappointing. And that might lead to a second leg down. So kind of similar again to bar 11. Similar idea. When that's the entry bar, traders might just sell the close. Bulls are disappointed. Bears are looking to get short. It looks like the same idea right here. Disappointing entry bar. Strong enough breakout. The distance. Again, the close doesn't matter as much. It could just simply be a breakout pullback on a smaller time frame. So you might have traders selling this close, and in this case we did. Now we have a 4-bar micro channel. Some traders might sell the close. It's not ideal because we're right at the bear channel line, but the market is always in short, and if you use a wide stop, at this point maybe above 33 or 27, you should be okay. More follow through, but really this is the first bar testing the channel line I have drawn here, and we still need follow through, and then we don't get follow through on 41. But this breakout, we have a 5-bar bear micro channel, and I had a couple of thoughts at this point. This breakout here is either exhaustion or some kind of measuring gap. And I had this channel line drawn. So you can argue it's a late leg, maybe 1, 2, 3, 4. Or what it could be is a leg count reset. Now, if we look at the 15-minute chart up to bar 39, that is 12:45. That's this bear bar closing near its low. So do you really want to buy when the market is in this tight bear channel? It kind of looks like a wedge here. You can count legs down. But remember what I said about the lack of overlap, the buying pressure. What I mean by lack of overlap is we have an open gap here. We have a negative gap here. And the overall point that I'm making is that it's easier to make money as a bear since bar 8 than as a bull. So then we had the stop order trigger above bar 40, 41. So 40 is a bad stop order long. Stop order signal bar. There's probably sellers above. Scaling in, this will probably get a second leg down. But bar 41 might be strong enough for its own second leg up. But in this case, we ended up reversing right back down. Now 42 is strong enough for more to the downside. And then a little bit of a surprise, 43. You can see we came close to the overall broad bull channel trend line that I had drawn down here. Other possible measured moves may be somewhere in the opening range like this. Market went a little bit beyond that measured move. So we're finding support. 43, yet another example of a bear breakout where there's very little overlap with the prior bar. And even though the close is weak, the odds are there are sellers above and we'll probably get a second leg down. So if a bear is short, stop above 41, it's reasonable to go for a test below the low of bar 43. We'll probably go at least one tick below this low. Bad stop order buy. The bar is big. It's a bear close, so it's a bad stop order. Sellers above. Breakout pullback. The market is in the channel phase, and when it's in the channel phase, bears look to sell rallies. So at some point, this bar was a bull trend bar on its high. The bears sell the rally, and then they take profits below bars or below swing points. So the bears will probably take profits below 43. We start to channel down, spike, pullback, channel. And look what happened when we fell below 43, profit taking. We also tested the big bull trend line and found buyers. Reasonable to exit shorts above 50, but not a very credible buy setup. Pretty tight bear channel, no significant trend line break, but the risk is real that we come back and test the high of bar 44. The market cycle here is complete. Breakout, pullback, channel. We have a second leg, and this channel will more likely evolve into a trading range and test back up here. Bears do a good job of not letting the stop order above 50 trigger. We're continuing lower, but again, probably profit taking buyers below bar 50. We came close again on 52. Now 52, we have a micro double bottom. It's a truncated wedge with 43, 50, and 52. And we're at support, a major support level, the big bull trend line. So for a couple of reasons, I think it's reasonable to exit shorts above 52, but not a very credible buy for the same reason 50 was not a credible buy. We don't have a trend line break. When the channel is this tight, it's better to wait for a major trend reversal. Surprise bar, 53, follow through 54. Good for the bulls, but there's a couple of problems. Remember I said we'd probably come back and test here. The problem is there are probably sellers here. If we think back, also we could look at bar 41. So somewhere in this area, the close of 41, the high of 44, we have a bear breakout. So traders, some bull bought the close of bar 41 and they were trapped on this bear breakout. And then some bull bought above 43 and they were trapped again. But the odds are if they scale in, they'll be able to at least avoid a loss and get out at their original entry price. The market rallies. What's a bull going to do if we test this price or this price or this price? They're probably going to look to take profits and just get out of their longs and look to buy again lower. So as strong as 53 and 54 look. Another thing is you always have to be suspicious when the follow-through bar is significantly smaller than the breakout bar. So the follow-through bar is 4.5 points. The breakout bar is 8 points. So it's a little over half the size of the breakout bar, and that's a problem. You compare that to a breakout like right here even, 38 through 40. The bars are uniform in size. They're not climactic. 2.25, 3.75, 3.75. So the bars are actually growing in size and they're not climactic and they're orderly. This is kind of a buy climax. Probably bears taking profits and bulls only looking for a scalp. And I said we need a trend line break if you're going to look to buy, but now we have one. So we rallied up to 54. That broke the trend line. The only concern I have with the major trend reversal argument here, for one, the bulls have one bar above the moving average. It's better if they get more bars above the moving average. Another thing, it's just not that many bars. It's 2 bars up. So I think at this point, more likely the market's in a trading range. And this is the top of the trading range, and this is the bottom of the trading range. So bad follow through, 55. Some bulls will take a chance buying the close of 54, but if you're buying the close of 54, you're betting on momentum. You maybe buy the close here, buy the close here, but when the next bar starts to hesitate, your premise is no longer valid because you're buying high in a trading range. This is a low probability buy. For major trend reversals, you look for a trend line break, which we got, then a retest of the trend's extreme down here, and then you look for a buy setup for the major reversal. And even in the best looking setups, only 40% of them result in major trend reversals. 60% of the time you get either a trading range or a trend resumption to the downside. So the risk here is that we come back all the way down here and test the high at 52. Bad stop order signal bar, trap traders, and when the market's in a trading range, gaps close. So we have a gap from the high of this bar to the current price, now to the close of 55. We'll probably get back down here. But the bulls, keeping in mind that the rally here up to 54 was strong enough for a second leg, but the problem is if the market's in a trading range, then second legs are delayed and breakouts get deep pullbacks. So again, the risk is real. We come all the way back down here before we get the second leg. 57, we tested the bad stop order entry price. We'll probably bounce and get a second leg up. But now the sell-off from 55 to 57 is strong enough for a second leg down. The problem for the bears, we're low in the range, we're at support. Traders were trapped here on this bar, and that makes the high of 52 a bad signal bar support. So this is not a great area to look to sell. And if any bull bought the close up here, uses a wide stop and doesn't panic and scales in lower at support, there's a high probability they can avoid a loss and make money on their second entry. So the same idea here for the bears. This breakout is strong enough for a second leg, but it's big up, big down, big confusion. And the second leg, because we're in a trading range, could be delayed after a deep pullback. And that deep pullback could be the second leg for the bulls. So we sold off again, testing this trend line. Now a bull reversal bar, probably going at least a little bit higher, but not a very good stop order buy. the signal bar is big, you're buying in the middle of a tight trading range, or an overall big up, big down, middle of this range. So not ideal. But we rallied. Now bar 60, a little bit of a climactic bar. Trend bars in trading ranges, really breakouts of any kind, you're expecting disappointment. Disappointment is the hallmark of a trading range. So 60, any bull buying here is taking a chance that we rally at least a little higher above 55, but they're really hoping we break far above and rally back up to maybe the open of the day. But more likely, the market's high in a trading range, and this is a second leg up, testing an area where traders got trapped and there's resistance. So the upside here, probably limited. Inside bear bar, high 1, sellers above, probably going to get a second leg down. And this is kind of how contracting triangles form. Big up, big down, but we're getting a higher low here, we're getting a lower high here. The bears, we go sideways for a lot of bars, and then the bears get a second leg down. But once we test support, we end up rallying again, and we're getting, again, higher lows and lower highs. In this case, we broke above, but we're still in the top of this trading range. For stop orders today, I thought the first reasonable stop order was selling below bar 10 based on the overall higher time frame context. We were high in that broad bull channel, 3 pushes up, lots of overlap, and you're high in the range. So I thought it was reasonable to sell below 10 for a swing short, and really not ideal for stop orders all the way through here with all the overlap, and really no great long entries because this ended up becoming a fairly tight bear channel. But if you're managing trades or trading in always in style, it's probably always in short by bar 12, if not earlier. And the way you can trade that is if you're flat, you can sell 1 tick below a bar closing below its midpoint and use the swing stop. So stop above bar 8, sell below 15, sell below 21. But these are not ideal because of all the overlap. And when the market's in a channel, in a bear channel, traders are selling rallies. So here's a rally and they sell it. Another rally, they sell it. Look at every bull bar through here. None of them really got any decent follow through, and many of them were followed by bear bars immediately. Good looking bull, reversal bar, and then a bear bar closing on its low. Another rally, and then terrible follow through, outside down. Rally, bad follow through. Rally, bad follow through. Rally, and then a bear trend bar. So really, all through here, traders selling the close of any bull bar was doing well. So for stop orders, selling below any bear bar, you could sell below 38, 39, 42. In here, we sort of had big down, big up, and the market's in a channel phase. So maybe you sell the low 2, low 1 below 44, low 2 below 47 for a second leg down. And then through here, 58, not an ideal stop order. I mentioned that. You're in the middle of the range and it's after 3 consecutive bear bars. 75 is a better stop order trade. You had the trend line break, a retest, another rally, another retest. We're getting a higher low. We're at support. Maybe you wait for follow through because it's after a 3-bar micro channel and it's a small inside bar. Maybe you buy here looking for a rally. But overall, the market is in a trading range and traders are mostly scalping. Where do we go tomorrow? Markets have inertia, and until something changes, I'm expecting more of the same. So I'm expecting another trading range day with sellers above the high of the prior day and buyers below the low. I am a little cautious, and I do think there's an increased chance that we get the bear breakout. And that's because we're high in this trading range, we're high in this trading range, we're far above the moving average. If you think about it, traders buying far above the average price, you need far above average bullishness. You need really bullish price action if you're going to be buying far above the moving average. Typically what that means is you need momentum. And so as soon as the momentum fades, like right here, here's a lot of momentum to the upside. Traders are buying closes. They're buying any small pullback, betting the market will continue to rally. And then you get that, and that's disappointing. And then the market goes sideways and more sideways. The odds get higher and higher that momentum traders are no longer buying, and we're going to have to pull back and test the moving average before we find buyers. And I think it's kind of similar here. Momentum to the upside, but now where is the momentum? It's kind of like right in here. So momentum, but within a trading range, the momentum disappears and we have a deep pullback. Momentum, the momentum disappears, we have a deep pullback. It's also supported by the smaller time frames, even though it looks like just a bunch of dojis on the daily chart. If you look from this bar, we are getting higher highs and higher lows, and that's that broad bull channel I was talking about. And what does Al say? Bull channel, bear flag. So like I said, I think this breakout still needs a second leg down, and this could all be a prolonged pullback. But I think more likely there's a 25% chance we get the breakout of the bull channel line, and a 75% chance we get the breakout of the trend line. And this evolves into at least a trading range, if not a bear trend. Before I wrap up this video, I want to end today's video with a couple of thoughts. And first of all, if anyone's listened to Brad, specifically one of his most recent reviews, he talked about the importance of having a trading plan or a system to follow. And by the way, I want to say that if there's anyone here who watches me but does not watch Brad, I recommend you watch Brad because he has far more experience than me and you'll learn a lot from him. And as I also want to say, as much as I make these videos to help everybody, these videos are a part of my practice and they're also for me. But with that said, I truly hope that even just one person takes one piece of information from my videos and uses it to help them in some way. What I'm doing here, I'm basically documenting my practice and tracking my progress here, and this platform holds me accountable. But there is a benefit to both parties because the viewer gets information and I get practice. So with that said, I challenge everybody to record a video of themselves talking through a chart. And maybe you're new to it and you can only talk for 5 or 10 minutes, and that's okay. But over time, you'll find that you pick up on subtle details, and eventually you can talk for 20 or 30 minutes. And suddenly you get to a point where it would take you hours to go fully in depth on 81 bars of a 5-minute chart. There's just an incredible amount of information on the chart, and I do my best to just summarize the key points. But we all start the same way. And, I used to watch all of Al and Brad's end of day reviews, and I still watch Brad from time to time. And there's no doubt that Brad watched Al's end of day reviews when Al was still doing those. And the point I'm making is forcing yourself to talk about the chart out loud and actually articulate your thoughts can be really beneficial. And I've come to the belief that the best way to learn anything is to teach it. And you don't have to post videos, but, teach yourself. If I wasn't posting YouTube videos, I'd still make reviews for practice. So again, I challenge everyone to try to incorporate this type of practice into their routine. Try it for a month or two and see what the results look like. And so with all that said, the main topic I wanted to talk about is about systems or trading plans. And I think I'll touch on that topic more in detail either tomorrow or on Friday. But for now, I'm just going to wrap up this video here. All right. I hope everyone has a good night, and thanks for watching.